The epicenter of risk is now in Asia. So what we've noticed, and we've been out with notes to clients over the last month about credit risk in Asia. So if you look at credit default protection on Korea, Vietnam, the Philippines,
It's
Malaysia.
the same stuff we were looking at with Greece for years, right?
Yes.
What does it cost to insure the sovereign debt of the nation?
If you're going to buy default protection, for example, in 2011, the European banks were a great leading indicator because when credit improved there, the cost of default protection improved. Two weeks later, U.S. equities rallied substantially in 2011. And what we saw over the last month is that credit's been deteriorating sharply in Asia, and sure enough, equities followed.
I don't think this sell-off is really reflective of concerns about the Chinese PMI number. You're right. We expected that. We know China's slowing down. What we're seeing is just the market retesting. It'll probably retest the low we hit last Tuesday. This is what happens in corrections. We don't think this is a bear market. We think this is a normal, healthy correction, but it doesn't occur in a V-shaped fashion. It takes a few months for the market to finally bottom and for the damage to be repaired. And what we'll ultimately see is the market head back down on lower volume. So the lower volume today is a good sign, but it's going to take a few months. And then ultimately we'll see the market move back from there, assuming that this is in fact just a correction.
Just a back and forth situation. Yesterday I think was inspired by the report that OPEC was willing to talk to other producers and other non-OPEC producers to reduce supply, but yet that's not going to happen for a long time. At the same time, an EIA report headlining a drop in oil production, I think, garnered a lot of viewership and really inspired some of the rally. But if you looked at some internal numbers, they actually increased their June crude stocks. So, that says that they might have lowered demand, but they might have lowered supply, but demand was also lower too if crude stocks actually were higher than they originally estimated.
When you're looking at what the incremental inventory build could be into refinery maintenance season, it could be north of 1 million barrels. So I think, all signs point to the fact that this isn't going to be a slow fix. I think there's, a lot of movement around whether or not, from a supply and demand perspective, the price that we're at actually achieves equilibrium in the market. And I think that at least yesterday's action, while we saw some bullish numbers, and it wasn't just on, non-OPEC or U.S. supply decreasing sequentially, we also saw some bullish refined product numbers. I think the question is whether or not yesterday's rally, or at least uptrend, has the conviction that's necessary to post a recovery. We don't think that it does.